All right. So today's session is going to be primarily all about a trade setup here on Bitcoin. And we're going to be going through a couple different concepts as well. So the concepts that we're going to be talking about are risk management, position sizing, and how to use the long tool on TradingView. So I have this pre-set up in here, so then we can, it's just easier to kind of look at the setup that I'm looking at here. So on the weekly time frame for Bitcoin, which is what we're looking at right now, we have our low here, high, higher low right here, and then higher high. So we have our trend, we're bullishly trending. So when we're bullishly trending, we're going to be looking for a buy on a support level. That's going to be what we're going to be looking for entries where we're going to be looking for continuation, the price to continue to go higher. And so I've marked up this purple area right here. And this purple area is this last down candle before we go up. And just one thing I wanted to quickly mention, if you guys have any questions throughout this, like feel free to just like either shout them out or put them in the chat, and I'll try and get to them, as soon as you guys ask them. Then that way you guys have the clarity that you want before I move on to the next thing. So what we're looking at here is the weekly time frame, like I said, and this support level right here is really important because if this level does not hold, that would mean that we're forming a lower low in comparison to this one, and that would be bearish. That would mean that the price should continue to go lower than this purple zone. And so,
Sorry, just a sec.
Yeah.
I know you've mentioned it quite a lot now. I just didn't quite fully understand the term bullish and bearish. If you could just compare the two for me.
Absolutely, yeah. So bullish means that the price is going to go up. The bulls in the market represent the buyers in the market, and the bears in the market represent the sellers in the market. So if you say that the price is bearish, you would say that the price is going down or it should continue to go down. So like, for instance, right here, you would say that the price is bearish. Once this candle is printed, you would say now this price action is bearish. And then once we start trending bullishly here, you can see that the price continues to go up because there's primarily people are buying. Does that make sense?
Yeah, that's great. Thank you.
That was a good question. So, so the purple level right here is really the level that I'm looking at, because if this level doesn't hold, like I said, we're going to be going down somewhere down probably near like 20,000 towards the previous all-time high level over here. That would probably be our main support level that we would be looking at. So this is a must-hold level for the bulls. So what we can do is, if we know we want to make an entry on this level, meaning we want to buy here, what we're going to do is we're going to be buying on the top of this purple rectangle. And if you guys have a TradingView account, you can actually use the, if you click on the little brush here, you can go in and click rectangle, and then you can put a rectangle on a candle and establish like a support or resistance level really easily. So that's what I like to use for my support and resistance levels, are those rectangles. But what I wanted to cover here was how you use this long tool. And I have this set up here. You can find the long tool on this toolbar right on this, what looks like three kind of lines with a couple dots on them and a dotted line. That is going to take you into this list of tools here, and you have your long position tool and your short position tool. So today we're going to be talking about the long position tool. And if you were to click that, this is what you would get. And what this is basically calculating your risk to reward ratio for you. So it's really quick and easy to calculate how much you could potentially make if the trade goes your way, and how much you could potentially lose if the trade doesn't go your way. So there's really only three key numbers in here that you need to pay attention to. I know there's a lot of different numbers in here, but there's really only three that you should care about. The first one is this green percentage up here. That is the percentage that the price would go up if we were to sell if we were to sell our Bitcoin. If we bought in right here and we sold it up here, we would make 54.07%. So if we bought at 37,874.71 and we sold it at 58,354.14, we would make 54.07%. The other percentage, the second one that you want to pay attention to is this 23.72 red percentage right here. This is telling you how much the stop loss is away from your entry price. So if your entry price is right here, 37,874.71, your stop loss is at 28,892.28. That would be 23.72% difference. And based on those two percentages, you get your risk to reward ratio. So in this case, it's 2.28. So this is the third number you need to pay attention to. And this is the main, kind of the main number that you want to look at. And so really all this is taking this number, the 54.07%. And you can see that this is 23.72% times 2.28 is 54.07%. So what this is telling you is you will make 2.28 times as much money if the trade goes up to here and you sell out here than you would make if you got stopped out down here at 28,892.28. Does anyone have any questions about that?
Okay, did you have to implement the shapes to get those points, or did you just?
That's a good question, John. So what you do is when you get the tool, you can move it around. And so if, our entry price is the top of this block, we know that that's at 37,874.71. So we can click on this and go to our entry price right here, and we can just type that in. So it's 37,874.71. I like to make it very exact. You can eyeball it by moving it around, but I like to make sure that it's exactly the targets. So then if we were targeting this high, the high of this candle, that's going to be 58,354.14. So we can go to here and type 58,354.14. Click enter on the keyboard, and you see how it automatically adjusted up to that percentage. And then we have our stop loss, which is right here at 28,800. So you're going to go down to your stop level, and you're going to go to price, and you're going to type in whatever the number is, and then it automatically moves it to there. And so now we know exactly what our risk to reward ratio is based on these exact coordinates. And that's what you want. You want it to be exact, because then with absolute clarity how much you'll make, or if the trade goes your way, and how much you'll lose if the trade doesn't go your way. So this trade would be a 2.26 risk to reward. And a couple notes about the risk to reward ratio. You really want to look for trades and investments that are above 2. I primarily like to look for risk to reward ratios that are above 2, because if we were to take a trade that was, let's say a 0.76, you can see that based on the red, that the red area is much larger than the green area, meaning that if the trade went our way, we would only make 18.21%. But if the trade went our way, didn't go our way, we would lose 23.96%, meaning we have a higher chance we would lose more money if the trade didn't go our way than it would even if it went our way. So it's not you're not risking, you're risking too much to make too little in that scenario. But once you get into the 2 range, like exactly 2, now if the trade goes our way, you can see we have a lot more profit potential than our loss potential. We have 2 times as much profit potential than we do on our downside potential here. So I'm just going to put this back to where it was here at 58,354. So now that we have that, and we know our risk to reward ratio is 2.26, we now say, all right, based on the support level, which is valid, based on the trend being bullish, I want to take an entry here. I want to go long at this price. So now that you know that, based on your analysis, this is kind of you doing your technical analysis. Now okay, this is a good entry point. So now what you can do is now you're going to calculate how much you're going to buy in with. Because if you're going to buy here, how much are you buying? Are you buying $100 worth of Bitcoin there? Are you buying $50 worth of Bitcoin? Are you buying $5,000? You have to calculate that out. And so that's what this formula is for down here. And so this is the formula to calculate position size. And position size is the amount of money that you're going to put into the trade or investment. It's the amount of money that you're going to buy in with. So in this case, what you do when you're calculating your position size is you're going to take your total portfolio value, which is the total dollar value or whatever currency you want to denominate it in. I use dollars. The total dollar value of your entire portfolio, which is all of your investments combined. So if, let's say for the sake of this example, it's $5,000. If it's $5,000, we're going to type that in here. You're going to multiply that by the percentage of your portfolio that you want to risk on the trade. So the typical rule of thumb in the trading and investing space is no more than 3.5% of your portfolio on any given trade. You don't want to risk more than that, because if you risk more than that on a regular basis, you could end up losing. If you lose a couple of those trades, you're losing a big chunk of your overall portfolio. But if you keep that really small, like let's say that we put 1% right here. Let's just put that in for this example. If we put 0.01, which is, you have to express it in a decimal for the calculation, that we're risking 1% of our portfolio. So what that means is our max loss on this trade, if we get stopped out down here at 28,800, will be 5,000 times 0.01. So that's going to be, I'm just running the calculation now, $50. So we would overall, if we got stopped out down here, we would only lose $50 on the trade, which is 1% of our portfolio. So you could take you would have to lose 100 of those trades in a row for you to not have any money left. And that's why that's important, because you don't want to consistently be betting a lot of, like, let's say we change this number to 30% instead of 1%. Well, now you can see that this changes your max loss significantly, because now you're doing 5,000 times 0.3, which is $1,500. So if the trade doesn't go your way and you get stopped out down here at 28,800, you'll lose $1,500. So that's why you keep this number small, because you're gonna, every now and then, like, it's just the law of averages, eventually you're gonna have a losing trade. And so the reason why you keep that number small is because when you do have a losing trade, your risk is really small. You're only losing 1%, which is basically nothing. So that's your max loss. So then you take that number, which in our case is $50, and you're going to divide that by the percentage the stop loss is away from your entry price. So we already have that calculated using our long tool, and that's the 23.96% down here. So we're going to type that in, and we're going to express that as a percentage. So it's going to be 0.2396. And if we take $50 divided by 0.2396, we will get our position size. So I'm just going to type that out right here. So in this case, what we would get is we would get $50 divided by 0.2396 would give us $208.68. I'm just going to put a dollar sign there so we know. So what that means is you would buy in with $208.6 right here at 37,874.71, and that would be your position size.
Can you be as specific as that?
Yeah, I typically, what I do is, John, if this was my trade and it was 208.68, I would just either round this up to 209 or round it down to 207.
And you could put any amount in the market.
What'd you say?
You can put any amount in the market as you choose. It doesn't matter what you get for that money.
What do you mean it doesn't matter?
Like you can put in that specific amount. I thought you kind of had to purchase a Bitcoin to be able to take the trade. So
Oh
surely
yeah.
the price of the Bitcoin fluctuates, so it doesn't always match the price you put in.
Oh, yes, yes. Yeah, that's a great question. And so in the cryptocurrency market, one of the nice things about it is you can fractionalize it, which means that you can buy either $1 worth of Bitcoin or
Hmm.
$5 million worth of Bitcoin. And it doesn't
Yeah,
matter. So yeah, you can buy in with $208.68 and you get a fraction of a Bitcoin.
yeah. Sorry, I've not done it myself yet, so I'm just not quite clear.
No, no, that's totally fine. These are great questions. Honestly, and the reason why they're great is because they probably help other people as well. So I appreciate those questions.
Right?
No, on you go.
Oh yeah. How do you show that you won't lose the 1% 100 times? How do you manage that?
Yeah, that's a good question, Max. So one of the questions, or I'm sorry, well, yeah, I guess one of the questions that I ask myself when I'm taking a trade is, how much do I want to risk on the trade? And so when I'm going into a trade, I evaluate this number based on the time frame that I'm trading on. That's how I trade. So what I do is if the trade is on the weekly time frame, I up my number here to either 2.5% or 3%, somewhere in between 2.5 to 3%. And the reason for that is because usually the higher time frames, like weekly or monthly trades, have a higher profit potential. And so like you can see, if this trade were to play out, this would be 54.07%. That is a significant amount of money if this trade were to go your way. And so that's why I risk a little bit more on the higher time frames. But if I'm trading somewhere on like the 4-hour time frame, Max, what I do is I only trade with like 1% or 1.5% of my portfolio. And the way I know it, your question was, if I remember correctly, how do you know, that you're not going to lose 100 times? Is that what it was?
Yes.
Yeah, so that has to do with the way you're building your strategy, which will be something that we talk about in coming events as well as videos. You have to build a strategy that you feel comfortable taking on a regular basis. Everyone has a different way of doing things in the trading and investing space. And so you're going to have a different, trading strategy most likely than I have. And so when you're taking your trades, it's very unlikely, Max, for someone to lose. Like if you were betting 1% of your portfolio on every trade, the reason why it's very unlikely that you'll lose 100 times in a row is because you learn something every time you lose money and you refine your strategy based on that. So what I do is when I have a loss, I look at the price action, I look at the technical analysis, and I say, why did I lose money on this trade? Was it because my strategy itself is flawed? Or did I not follow my strategy? Now, typically, once you get to a certain stage of understanding the market, it's usually the latter. It's usually you just didn't follow your strategy. And that's why implementing something like an automated trading bot is really effective, because it cuts that element out. It cuts that emotional element out, because what I find sometimes I end up doing is I end up taking a trade off of an emotion. Like I end up just going, oh, I think the price is going to go down, and then
Yeah.
I'll sell. And then, then you're sitting there a little while later, the price continues to run up. Like I did that somewhere in here. I was selling, and then the price continued to go up, and I had to sell out up here, and I had a loss.
Mm-hmm.
And so that was an emotional trade where I wasn't following my strategy. And so that's why you work in conjunction, you work kind of form like a partnership with technology, where the technology is executing a strategy that you created. So then that way, you don't have to worry about that element of it. And if the strategy is a profitable strategy, it'll automatically execute that strategy for you, and you just reap the benefits of that because you did the work of coming up with the strategy. And so now you just reap the rewards of the bot automatically trading that for you. And you don't have that emotional element of like, if the price goes down significantly and you probably should buy, but you're a little bit scared, like that's what usually happens to a lot of people, and it's happened to me. It makes it difficult for you to buy, but it is that, that area is confluent with your strategy, so you should be buying. The bot will just end up doing that for you. And so that's how you kind of make sure that you'll really never, if you're risking 1% of your portfolio, you'll really never get to the point where you lose, every like 100 trades in a row, because you end up refining your strategy as you go and go, okay, that didn't work. Let's try something else. And you can test that. And the other benefit of using like a automated trading bot is you can back test different things without actually risking any money. So that's the other reason why you would really never lose your whole portfolio if you manage your risk, because you can use technology to back test different strategies you have against previous price history. So like you could test a strategy, in like this price range over here, using all of this price history, and test a strategy to see how it performs. And you're not putting any of your money on the line. You're not risking any money. You're using technology to just test how that strategy should perform on a regular basis. And then once you see that it would be profitable, then you can start putting some money in and doing it with a position size calculation. So you're managing your risk and using a stop loss efficiently.
Okay. Okay, thank you.
I had a question about the time factor. You talked about how you can trade on a 4-hour period, a weekly period, a monthly period, etc. Does that mean if you put money in and you're, say, on the weekly period and the market goes down on a daily basis, that doesn't influence your position? It's based on what happens at the end of the week?
Yeah, so that's a great question. The time frame thing is very important, and I'm very glad that you brought that up, because for instance, this trade, for instance, right now, if we go down to the daily time frame, you can see, before we go down to the daily time frame, I want to show again that we have an intact bull trend here. We have a low, high, higher low, and then higher high. So this trade is still valid on the weekly time frame. But if we go to the daily time frame, now we're starting to look kind of bearish, because if you look at the price action here, we have a high, low, lower high in comparison to this one. And then now we're doing a lower low. Now, if we end up closing below this low, that's a daily confirmed bear trend. But that doesn't necessarily mean that the weekly time frame level is not valid, because the weekly time frame isn't going to show the daily price action, because it's all contained within this one candle.
And if you trade on one time frame over another, what happens to your position?
It's the position is going to be based on the actual price itself. So when you're trading on the weekly time frame, you can manage the trade, and that means like manage it as in like, you're analyzing the chart on this time frame, and you're not really going down to lower time frames and say, all right, if the price goes down to like, that's why you use a stop loss, really, is because you don't have to manage it too much. Once you set it up, you should just be waiting to either make money for it to bounce off this purple level and then make money, or go right through this level and stop you out. And so, but to answer your, what'd you say?
Do you typically change which time frame you look at? Do you analyze all before you make a trade, or?
I do. Yeah. So I personally, what I do is I start at the monthly time frame and I work my way down. So starting at the monthly time frame, for this trade, you can see that we have this long upper wick of people taking profits. And so I would start there and say, okay, there is a chance that this monthly candle closes in a day and 5 hours, which isn't very long. And so if this candle, closes with a long upper wick, we may the next month go down to, we may trade down lower because people were selling into this rise in price. So you factor that in when you go down to the weekly and you're saying, all right, I'm thinking about buying here. Should I buy here? And so I give the higher time frames precedence over the lower time frames. because like, for instance, if we go to the 4-hour time frame, we could say, all right, I'm going to go long here because like the 4-hour time frame, like if we were to make a higher low right here and then higher high, you could say, all right, and now I'm going to go long. But if the monthly time frame closes with a long upper wick in a day and 5 hours, that matters more than a 4-hour bullish trend. And so once that monthly candle closes, this 4-hour trend is not going to matter very much. People are going to sell and it's going to go down through that trend anyways. And so that's why I always look at and make sure that my trades that I'm making, if I'm making a trade on the 4-hour, that it's consistent with the trends on the higher time frames. So if the weekly is trending bullish here with a low, high, higher, low, higher, high, and the monthly is trending bullish. So that means that those two timeframes are bullish. So then you can go to the daily and say, all right, well, then I can make a daily bullish entry. But you can't make a daily bullish entry right now because there's no trend to go off of, because we're just kind of getting this chop. Does that make sense, John?
Yeah, absolutely. Yeah, thanks.
Okay. Good. That was a great question. Yeah, I haven't talked about that much yet, just because I wanted to cover some of these preliminary topics before we get into like the time frame management and different things like that. But yeah, that's an important point. You're always looking at all of the time frames to make sure that you're not taking a trade, because what you don't want to happen, John, is you take a trade on the 4-hour time frame and then the weekly has something happens on like the weekly time frame, and then you get stopped out of the 4-hour time frame because it wasn't consistent with the weekly.
So I have one other basic question, which I
Fire away, John.
see on the right side of the screen, all these numbers that are changing, green, red, blue. I don't entirely know what they mean. Yeah, is there anything on that side that we should take note of and monitor that helps with the trade?
Yes. So this is just a little box that TradingView has that gives you information on the asset you're looking at, which in this case is Bitcoin to USD. So right now, this is the current price of Bitcoin on this exchange, which is Bitstamp. So right now, the price of Bitcoin is 47,271.22. And as people buy and sell, this price changes. So people buy and sell, and then it moves the price, right? So that's when it's green, that means the last order that got executed on the exchange was a buy. And when it's red, that means that the last order that got executed on the exchange was a sell. And for context, a couple of these other numbers here. This number is the percentage that the asset you're looking at has either appreciated or depreciated over the course of the day that you're looking at. So over the course of today, from where we opened down here at 46,324, we've appreciated 2.09%. Well, now 2.07. So you can see how it changes as people buy and sell. And then here's the day's range. So this is like the lowest price that Bitcoin traded at throughout today on this exchange, and the highest price that it traded at on this exchange throughout the day. And then the 52-week range is the same exact thing as the day's range, but for the last 52 weeks. So this is the lowest price Bitcoin's traded at over the last 52 weeks, and the highest price it's traded at over the last 52 weeks. And then the performance, this down here, don't pay attention to this. This is not that useful. Like it's always going to say buy when the price is going up, and it's always going to say sell when the price is going down. So it does you no good, in my opinion. But this part right here, the performance section, this shows you how the asset has performed over different time frames. So 1W means 1 week. So over the course of 1 week, Bitcoin has went down 12.87%. 1M means 1 month. So over the course of the last month, Bitcoin has went up 20.16%. 3 months, 78.35%. 6 months, about 260%. YTD is year to date. So since January 1st, 2021, we've went up 62.8%. And then 1 year, so over the last year, 1Y is 408.47%.